The reverse repo facility at the Federal Reserve has begun gaining attention again in the news because it has started to drain again and is now headed back to zero. This is a chart of the reverse repo facility, and you can see for a long time it was not used. After the trillions of dollars of printing, the Federal Reserve changed the rules for the reverse repo facility, started paying an interest rate to banks that held their money here, and you can see the usage exploded to a peak of well over $2 trillion. Then when the Federal Reserve began tightening, you can see it quickly started to drain until it bottomed in about April of 2024 and started moving sideways from there once the Fed's tightening ended. But now the draining of the reverse repo facility has begun again, and it is headed back down towards zero with only about $227 billion left. So what will happen when the reverse repo facility hits zero? Because in the past, myself and others have talked about how this would cause a liquidity crisis. Now, things are different, and it probably won't cause a liquidity crunch, but that's not necessarily good news because the reasons why it's not going to cause a liquidity crunch mean that something worse is going to be happening instead. So first, let's do a brief primer on the reverse repo facility so you understand what the heck we're even talking about here. Repo stands for repurchase because banks overnight will either need cash or collateral from each other depending on how the day goes. So banks will come to the repo market, which stands for repurchase, and they will offer collateral or offer cash in exchange with each other at the going normal repo rate, and they will promise to repurchase it back from each other at some point in the future. The Federal Reserve has become more and more involved in the repo market over the last few years because they want to make sure the repo rate doesn't get out of line. So they are there to offer collateral or cash to banks as needed. The reverse repo facility at the Federal Reserve is where banks go to give cash to the Federal Reserve in exchange for the collateral they need for their regulatory requirements. And as a reward for using this facility at the Federal Reserve, the Federal Reserve will pay an interest rate to that financial institution on the cash that they deposit with the Fed in this facility. And I call it a reward because the Federal Reserve themselves call it the overnight reverse repurchase agreements award rate. It is literally an award to banks that decide to deposit their cash with the Fed. You can see that from 2021 up until 2023, the Federal Reserve was increasing the award rate until it topped out at 5.3%. Not coincidentally, this is the exact same time frame that sucked in the $2.3 trillion into the facility. The Federal Reserve then held the award rate at 5.3% until recently when they cut interest rates and dropped the award rate to 4.8%. And now that this facility does not pay as much, money has started to drain out of there yet again. Now, in the past, I myself talked about why this would cause a liquidity crunch when this facility hit zero. The reason why is because where the cash came from in the first place. This was trillions of dollars of deposits that entered the banking system that had no collateral to offset it. That's why the banks needed the Federal Reserve to open up this facility so they could use it to get their collateral without pushing short-term interest rates negative. Real quick, I'd like to inform you about something very important coming up in just a few days. It's no secret that we are facing one of the most contentious elections in US history. The two candidates couldn't be more different from each other, and the polling odds are changing by the day. And to be honest, they're changing depending on who's doing the polling. That's why on November 3rd at 7 p.m. Eastern time, just 2 days before the election, I'm hosting a live Zoom call to detail something I call the election chaos trade. It's a special trade that has historically soared in the months following the election. In fact, in the past, this trade has thrown off gains as high as 173%, 363%, and even as high as 1,455% in a matter of months following an election. And even though massive 1,000% gains are the exception, they're not the rule, I want to show you why I believe this year's election chaos trade could be the biggest yet. If you're interested, simply click on the link in the description below, sign up for the event, and show up on Sunday, November 3rd at 7 p.m. Eastern time. Attendance is completely free, but seats are limited on the Zoom call. I'm incredibly excited about this opportunity. I cannot wait to share it with you, and I look forward to seeing you there. As this facility started to drain and head down, that meant cash was leaving this facility and being used to go buy short-term debt like T-bills. This meant the United States government could borrow basically an unlimited amount of debt using T-bills because they had $2 trillion that would come out of the reverse repo facility in order to be lent to them as long as the rate was right. But if this repo facility would have hit zero back then, the United States government would not have been able to continue borrowing at the rate they were borrowing by using T-bills. And at the time, auctions for long-term treasury debt were going terribly, which meant interest rates across the board would have spiked, there would have been a liquidity crunch, and the Federal Reserve would have had to intervene. But obviously, none of that happened. The reverse repo facility did not drain, even though it is doing so now. But the environment has now changed. And unfortunately, I don't think it's for the better, which means this source of cash will dry up and the government borrowing will not pull more money out of this facility. But the Federal Reserve has recently changed its policy stance. Number one, it has now started lowering interest rates. Especially at the short end of the curve, this makes it easier for the US government to borrow more money. But that's not even the biggest policy change. The Federal Reserve is going to be ending quantitative tightening soon. How do I know this? It's because the reverse repo facility is almost empty. Recently, Lori Logan, who is the Dallas Fed president, delivered remarks at the Securities Industry and Financial Markets Association annual meeting about normalizing the Fed's monetary policy tools. And if we analyze some of the things she talked about, we can see very clearly the Federal Reserve is anticipating the reverse repo facility hitting zero, and they're changing their policy in order to accommodate that so that there is no liquidity crunch and the government gets all the financing they need. First of all, for months, they've been watching the reverse repo facility knowing it will eventually approach zero. And back in March, Logan herself detailed why they needed to slow down quantitative tightening. Brief explanation of quantitative tightening. The Federal Reserve has a balance sheet. You can think of this like their brokerage account, except they don't have to deposit money in it to be able to buy assets. They just print the money. Now, on their balance sheet, they have two kinds of assets that they've purchased: mortgage-backed securities and US Treasuries. When their balance sheet is growing, it means they're printing money in order to buy more assets. Therefore, their balance sheet is growing, and they call it quantitative easing because the money supply grows as a result. Quantitative tightening is the opposite when their balance sheet is declining. This means they are either selling assets off their balance sheet and as a result destroying the currency that was used to purchase it, or they are just letting debt on their balance sheet get paid off passively. Either way, their balance sheet declines. This is a chart of the Federal Reserve's balance sheet, and you can see ever since 2022, they have been engaging in quantitative tightening. In other words, their balance sheet has been declining. This has been primarily through allowing debt held on their balance sheet to get paid off. This is a tightening force on the money supply, which means it decreases liquidity, which means if they're doing that at the same time as the reverse repo facility hits zero, they have the potential for a liquidity crunch. But as the Fed's Logan points out, they're not going to let this happen. Now, the Federal Reserve's balance sheet is key here. We have to look at the composition of the treasuries because not all treasuries are created equal. The US government is doing far more borrowing at the short end of the curve, meaning borrowing with debt that is due to be paid back in 1 year or less. This is because there's a lot of demand for that kind of debt. But as of right now, the Federal Reserve has not been helping out with that very much. So the Federal Reserve can make a few changes to their balance sheet that can make borrowing even easier for the government, even without restarting QE. Yes, if their balance sheet is moving up, it is very easy for the government to borrow because they're essentially borrowing directly from the money printer. But even if the balance sheet starts to move sideways and there's no QE or QT happening, the Federal Reserve can still make changes to the actual assets they're holding that makes government borrowing much easier still. Logan discussed how making these changes would allow them to operate in the long run with only negligible balances in the overnight reverse repo facility. Meaning these changes she's talking about are directly applicable to the reverse repo facility hitting zero, but still needing to apply easy financing for the government. Logan indicated that the Federal Reserve should hold a neutral treasury portfolio, which would be one with a maturity composition similar to that of the treasury universe. Right now, the Federal Reserve's balance sheet is overloaded with longer term maturities, and only 4.5% of its treasuries are T-bills, meaning debt that matures in under a year. However, 22% of marketable treasury securities on the market are T-bills, which means to get a neutral composition with T-bills at 22% of its treasury holdings, the Federal Reserve would have to replace a lot of its longer maturity debt with T-bills. Just in case that's not clear, they're saying that the Federal Reserve could twist or shift the composition of the debt it holds on its balance sheet without changing the overall amount, hold a lot more T-bills. This alone would make it easier for the US government to continue borrowing at breakneck paces, because that's the type of debt the government is issuing right now in order to do all of its borrowing, which means it wouldn't need to suck it from the reverse repo facility anymore. It's getting it directly from the Federal Reserve as a result of them shifting their balance sheet around. But it doesn't even stop there, because Logan said instead of just getting to a neutral composition where we match the market, we could actually tilt towards shorter maturities, where even more T-bills would replace more longer-term securities. She mentioned that this would matter if the Federal Reserve had to cut interest rates back down to 0% again, and the economy still needed even more help with longer-term rates. That way they wouldn't have to restart QE. In that case, they could then let the T-bills run off the balance sheet and then replace them later on with longer maturities. Okay, let's read between the lines and put this all together so that anybody can understand what the Federal Reserve is planning for here. Right now, there's no recession officially. There's no economic crisis, although we do have a lot of trouble brewing, and that's what the Federal Reserve sees here. Even so, the government is spending at breakneck speeds. So the Fed has to accomplish two goals. Number one, it has to position itself to be able to print money for the future when all of the trouble hits, because that's what it does. But number two, it also has to supply the funding the government needs right now for its spending during normal times. So how can it do that and still act like it's trying to fight the inflation that it caused last time? Number one, the Federal Reserve shifts its balance towards T-bills, that is short-term debt, because that's where the government is doing all of its borrowing right now. Every time the government pays back a long-term bond, when it's something that they borrowed 10 years or longer ago, they are normally replacing that right now with short-term debt. If the Federal Reserve decides to shift around its balance sheet, even if the size stays the same, and go towards filling up its balance sheet with the short-term debt instead, that helps the government maintain its breakneck spending speeds. Number two, if we do end up getting a recession, a depression, a crisis hit sometime in 2025 or later as a result of the bust that we see forming right now, at that point, the Federal Reserve could shift the composition of its balance sheet back towards longer term treasuries as a result of the insane borrowing the government's gonna have to do at the long end of the curve. Now, I know what you're thinking. Well, if they had to do T-bills right now, how will that help to go back to long-term debt later? Well, it's because the Fed will have cut interest rates to zero. So at the short end of the curve, interest rates are already zero. So the government won't need help borrowing at the short end of the curve then. They will need help borrowing at the long end of the curve. So the Federal Reserve can get rid of all that short-term debt, replace it all with long-term debt, thereby helping the government both at the short term and at the long term once the crisis hits. So let's make it even simpler. The Federal Reserve is fully prepared for the reverse repo facility to hit zero. They're going to be pulling some shenanigans with their balance sheet to help the government spend right now. And they are fully prepared for a recession, depression, crisis to hit to cause even more printing for the government to continue spending and borrowing while obscuring the view and trying to make the public not understand what they're doing. And this is why I said we're not going to get the liquidity crunch from the reverse repo facility hitting zero, but the reality is actually worse, because all of this just means more money printing. And that means more deficits, more debt, more spending, higher prices for goods and services, and wage earners are not going to keep up. There's even more evidence pointing to a future I've been talking about for a while, where the rest of us are going to have higher prices, more inflation, and higher borrowing costs for the foreseeable future. We are in a new phase of the long-term debt cycle, and it's going to be a bumpy ride. In a world where money is easy and abundant, continue buying assets that are hard and scarce. Stay uncorrelated, stay hedged, and always take advantage of extreme moves when you can. Speaking of that, only a couple of days left. Make sure you hit the link in the description below to find out more about the election chaos trade coming up in just a few days. As always, thanks so much for watching. Have a great day.